Good evening. This is Ken Long from Tortoise Capital with a review of the weekly trading report for August 17th, 2013. Everybody out here in Raleigh says hi to you. The market is in bullish normal conditions. On an annual basis using weekly RSI 14, it's at 60 out of 100, so at the higher end of neutral. On a 10-day basis using the 10-day NDX, we have a score of 6 out of 100, which puts us deep into oversold territory. Looking at the market mosaic, price relative to the 200-day moving average has pulled back to 7.59% above the 200-day, which puts it into yellow bullish, meaning that it's getting weaker and approaching sideways market conditions in about another 4 or 5%. The slope of the 50-day moving average has degraded further to yellow neutral at plus 0.29. ADX 14, the measure of trendiness, is down to 16.9, and we have an untrending market with with bears in charge, and that's a bad thing for the long side. ATR percentage remains at the low end of normal at 0.80%. The VIX risk index, which is the 30-period moving average of the VIX divided by the 10-period moving average of the VIX, comes in at a score of exactly 1.0, so that those two moving averages are identical, and that puts us into risk-off conditions, meaning that the riskier trades are no longer warranted. If we took the z-score of that risk index of 1.0 and looked back 5,000 days for our standard, we'd find that's a z-score of minus 0.12, so we have just moved into risk-off territory. You can see the last 90 days time series on the histogram here, and we have come down from a plus 2 z-score all the way down to the 0 line. And as we know, over the last year, the last 5 large VIX spikes occurred after a pullback from a high z-score right down in the vicinity of the 0 line, which is exactly where we are right now. So conditions are very ripe for a sudden system shock that would cause the VIX to be an explosive move, and so that will be my primary target. If the market shows weakness, I will check the VIX first in order to play the high payoff volatility trade. In the blended monthly rebalancing system, the 32 ETF portfolio continues to hold financials, U.S. small caps, and consumer discretionary. And in the 13 ETF portfolio, that's the Russell small caps, then the mid caps, then tech. So the U.S. continues to dominate. No change in those holdings, and the next reevaluation will be on or about 1 September. In ETF 2, the theoretical exposure of the model is at 60%. The model portfolio itself is at 80%, so the market got incrementally weaker this week because of the sell-off. You'll see a couple interesting trades of the week at the YouTube channel that were posted earlier this week. Taking a quick look at the current readings on the blended monthly rebalancing, you see 2/3 of the 13 ETF portfolio are on cash. That's a measured increase in weakness. The 3 or 4 strongest are all the U.S. indices, small caps, tech, large caps, then mid caps, and the remainder are all on cash positions, meaning they're below their 4-month moving average. Scrolling down to the 32 ETF expanded portfolio, again, about half of them are on buy positions. And in the expanded set, the winners are Russell small caps, U.S. industrials, technology, financials, and then consumer discretionary. So the leaders continue to lead, and that is strength within the U.S. sectors. Taking a look at the market health check, the vertical blue lines represent 10, 20, and 30 days of look back. The solid purple line at 171 is the recent swing high of the ribbon, and it takes price to close above that to suggest that the market is poised for upward expansion with no resistance overhead. And meanwhile, we will play tactical trades inside the river in the floodplain until we get past 171. The black line in the center is the 30-period regression line lagged 1 day. The outer channel formed by the black lines are the RAF regression channel, which are the maximum excursions from the regression line during the 30-day look-back period, and we are exactly on the southern boundary of that, which suggests that the market is poised for a sharp change in the underlying truth. When you combine that with the 10-day sell-off and the VIX poised for an explosive move up, we are at a critical state in the market in which a strong move in either direction is easily forecasted and follow through can be large. This could be a 5 to 8% move this week in either direction, commencing with sudden moves in right from the morning trade. I believe the market is in that condition, and it will drive what any follow-through occurs in sectors and companies. So if you get the market and volatility right this week, you'll be well positioned for success in either direction. You'll notice that the dark blue shaded area of the river, which is the 30-period Bollinger Band plus or minus 1 standard deviation, is still relatively narrow, although it's getting ready to expand. The slope of that river has started to stall and is beginning to roll over. The slope of the 30-period regression line is this black sine wave in the background, and you can see that's made a double top and is coming back towards the zero line, which is this dotted line, which says that the market is losing steam over a 30-day basis as the slope of that begins to roll over, as influenced by the last 2 heavy days of selling. Thursday last week was a big gap down and a big red candle down. Friday was failure to fail much further, but there was no conviction on buying, and so the market remains poised at this critical state. If it fails through this important resistance at about 165, the next targets are at 160 and all the way down to 154. The dark red shaded area at the lower right-hand corner of the chart is the 200-period moving average, and that is creeping forward. So as we get closer to that, the market continues to age and stall, and the conviction is leaving the market. Looking at the Williams percent R, the market has been oversold for the last 2 days and has shifted from that long period of outperformance to current weakness. The bottom indicator is the percent price oscillator, which behaves just exactly like the moving average convergence divergence histogram. You can see that the jaws of PPO opened to the downside 10 days ago and has begun to accelerate to the downside. That gave us warning 10 days ago that market weakness was coming in, and nothing since that time has caused us to change our mind. At the top, you'll see the ADX indicator is still low at 16.9, but the bears are in charge, and an ADX reading of 17 says that there is plenty of room for a intermediate term trending move to develop over the next week to 10 days, which could be an 8 to 10% move in either direction before the market became strongly trending. So that's why we have the market currently in a critical state, poised on a knife edge to go either way in a strong move, and the market will favor those agile traders who can shorten up their time frame and pile on momentum whichever way it starts to move out. So you will be rewarded for that skill in the days ahead this week. Taking a look at the ETF2 regional report, 6 out of 10 of the indexes are on a buy position, meaning they're better than their 4-month moving average. That puts the theoretical model at 60% invested, 40% cash, which is a 10% weakening from last week. The U.S. is continuing to outperform the globals, with the S&P ranked at 54 on the strength index, and EFA, the globals, at 53. This is the closest that EFA has been to the U.S. in the last 2 months, and what that says is that the advantage the U.S. has had is starting to evaporate, and that the weakness in this market is centered in the U.S., and this could be a place where the U.S. Relinquishes its position of leadership back over to the globals. If that's the case, then EFA would be the logical target going forward, because that's a mature, large cap, broad set of indexes that favors a conservative approach to equities. If that happens, then we might see the emerging markets follow through. But if global leadership shifts to the globals, then EFA will be the new leader out of those 10 regions going forward. But for right now, it's the U.S. But it wouldn't take much to tip that over to the global side, and that would be a change in leadership that has lasted for 6 months with the U.S. in charge. The two strongest sectors right now are small caps and tech in the U.S. The two weakest sectors remain Latin America and emerging markets. Inside the U.S., the order of march is small caps, then tech, then large caps, and then that should read MDY or the mid caps. Inside the U.S. sector spiders, the four strongest sectors remain financials, industrials, healthcare, and consumer discretionary, and all of those represent mostly defensive, conservative plays in terms of growth. And so this is not a market that is poised for positive follow-through. This is a defensive market getting ready to change leadership position. Looking now more broadly at the world market model, everything in the U.S. remains above average. Only small cap growth remains strongly above average in the green at 60. Everything Europe is strong. Multiple countries in Europe are strong compared to weakness inside the Asia and Asia less Japan sector. Inside the other asset classes, oil remains exceptionally strong at 67. That's the strongest sector on the board right now. U.S. real estate and treasuries are suffering. It wouldn't surprise me to see that U.S. weakness in equities would translate to short-term buying opportunity in treasuries, which have been lagging the last 6 to 8 weeks. And so look for strength in treasuries if the U.S. equities get weak. TMA, for those of you tracking triple leverage treasury ETFs at home. Everything else in the Western Hemisphere looks weak except Canada, which is slightly above average. Inside the business sectors, there's almost parity now between the U.S. and the global business sector counterparts. That has been the U.S. dominating in every one of those until this week when it's come back to about parity, and that lends strength to the possibility of this being a turning point in market leadership, so we'll keep our eye open for that. Looking at the top 30 ETFs in the ETF2 database, the leaders continue to lead. That's the solar ETF and the alternate energy. Still lots of regional finance, oil and oil services, biotechnology. The Netherlands remains strong for the fourth week in a row. Silver miners had a big boost this week. You'll notice that their current strength ran all the way up to 65, while their 10-week consistency rating and volatility rating are deeply in the red. And so this represents the results of a 4-day extremely strong move in silver. And so we're looking at that as an opportunity for follow-on momentum plays in the week ahead, particularly if equities suffer across the board. This would be a logical place where silver and gold could definitely come into play as alternative hedges. We're looking for emerging strength leaders when it's green in the strength column and white in the consistency column. And so that represents new areas of strength because the current strength is greater than its 10-week moving average. So that would include oil, the Netherlands, France, Spain, the EMU index, the consumer staples alpha index, the Euro stocks, U.S. small caps remain strong, and then Italy. So you can definitely see new leadership emerging out of selected countries in Europe. So keep those on your radar. The early leaders when market changes can often be the long-term leaders for the next few weeks and months ahead. Inside the Dow 30, the performance of Hewlett-Packard continues to amaze. Its strength rating is 100. So out of the 1,500 ETFs and the 30 stocks that we follow, Hewlett-Packard is in among the top 2 or 3 and has been consistently green for the last 3 months. So if there is strength in a rebound in U.S. sectors and if technology is doing better, Hewlett-Packard is your go-to as the no-brainer as a leader in technology. If that's the top on the board, pile on and enjoy the ride and manage your overnight risk. 2 other emerging leaders are green on strength and white on consistency. That's Merck, United Tech, and 3M. We have a new loser in the Dow 30, that's IBM, has now moved to the bottom of the stack, displacing Alcoa and Caterpillar. And for the first time in 4 months, we have a U.S. large cap that has a red rating on strength, and that's IBM. As you'll recall, over the last 4 months, even the worst performer in the Dow has been at least in the yellow, and that's been a measure of broad strength in the U.S. large caps. But now you can see the weakness beginning to enter as the worst in the Dow has now tipped into the red. More evidence for a potential change of leadership between the U.S. and the globals. Looking at market liquidity among the ETFs, these are the top 30 by average daily dollar volume. Those that are in the green in the ATR percentage are exceptionally volatile intraday compared to their peers, and that's the gold miners at 4.37% ATR percentage on average per day, which is even more volatile. It's 33% more volatile than the VIX, which comes in at 3.24%. So that's something new. That's something you don't see every day, something more volatile than the VIX. And then those in the red are exceptionally unvolatile. That's the high-yield bonds and corporate-grade bonds. Shifting now to the daily report, which is Friday's daily and leading into the trading day on Monday. I won't repeat those that were already covered, but we shift now directly down to the overreaction system and the channeling system, and you see all the U.S. indexes have fired. The spiders, the tech, the diamonds, mid caps, small caps in both systems, and so these aren't separate signals. This is a reflection that the entire U.S. market has pulled back significantly and triggered those criteria. Now, those are reliable systems on the long side, but because the market is poised at such a critical state, I would wait to see evidence of reversion to the long-term primary trend before I enter this automatically tomorrow. This is a case where sticking around a little bit intraday is worth the extra attention. Looking in the lower left-hand corner, you can see the flow of volatility, how it has gone from almost 2 standard deviations above normal down to the very low end of normal and into the quiet, and has now started to hook up. That's not a good sign for equities, and that's a great sign for potential plays in the VIX, which says that volatility trends may have reversed, and it's still early in that life cycle, so we have not yet seen a spike in VIX volatility. If you are long XIV, the inverse volatility, and as a swing trade, make absolutely sure that your stops are in place and that you're protecting the profits of that exceptional move up, and be prepared for a sudden system shock. Looking at the pattern trades in the lower right-hand corner, we have a handful of excellent setups among the ETFs for both channeling and overreaction, and in the 5-day down where U.S. real estate, utilities, and Latin America all hit that criteria. If we see weakness in the market tomorrow, and if Latin America is doing worse than the S&P, that's a early go-to for a short in Latin America because it's the worst of all the big regional indexes. So if it continues to lead the way down, that's the easiest short in the world. Looking at 551W, we have XLI, the industrials, General Electric, United Health, 3M, United Technology, and Hewlett-Packard. So if we see strength tomorrow and you see Hewlett-Packard, take out Friday's high, pile on the leader, which is in an excellent swing trade posture. Meanwhile, in the auto framer, those are the symbols that test out better than 2-to-1 on a trade location basis, based on a profit target of the 10-day high, and with the entry 5 cents above Friday's entry, 5 cents above yesterday's high, and with a stop 5 cents below Friday's low, and all of these test out better than 2-to-1. So that's IBM, McDonald's, Disney, Diamonds, Walmart, 3M, Midcaps, Johnson & Johnson, and XLP. All of those, except IBM, have been long-term leaders, and if we see follow-through, those are your early go-tos for strength leaders. I'd be willing to trade any of those if they're at the top of the intraday stack. Taking a look at the Dow 30 tactical summary, we see there almost every one of them is on a channeling and overreaction signal. We have 3 good 5-day down candidates, 3 good triple screens, 5 good 551Ws. Taking a look at the max pain range compression, Cisco, IBM, Disney, McDonald's, and JP Morgan are all excellent. They all test out better than 3.5 to 1 on an auto framer. And as you can see, IBM tests out at almost 7 to 1 reward to risk just using the auto framer. Looking over at the highlighted green column in the RSI2, anything that's in a single digit RSI2 is something that has washed out sharply over the last 2 days and could be in an oversold condition, and on a technical basis may give us a good one-day bounce. So any one of those candidates are exceptional. And so when you see this many swing trades and this many short-term candidates, what we have here is a market condition that's creating this opportunity and not so much the sum of the individual parts. That leads me to say once more, if you get the market direction correct and the volatility direction correct this week, then you'll be well postured for just about any target that follow through. Get the market right this week and you'll be in good shape. Looking at the ETF 30 tactical summary, we see exactly the same thing. More than half of them are on RSI2 values. A ton of them test out better than 2 to 1 on the auto framer, and there are plenty of targets that have dojis, channeling, and overreactions. So this is a broad market condition. Again, find your favorite broad index or the market itself. Make sure you get that one right. Inside the auto framer, you have a listing of all those ETF 30 and Dow 30s that test out better than 2 to 1 on the basis of a trade frame and trade location. You can see in the green column in the center their calculated reward to risk ratio based on a mechanical entry 5 cents above Friday's high, with a mechanical stop 5 cents below yesterday's low. You can see this is ranked in reward to risk ratio, and in the framing data you have those entries and exit points automatically calculated for you, and then you can see some additional information like ATR percentages and frog quality numbers and so forth, so you can prepare your trading plans. Looking at the market mosaic, these four additional targets, charts, I want you to look at the top left 30-day regression line of S&P. That's the last 30 days. The thick blue straight line is the straight up linear regression line. You can see the slope is rolling over. The curvy black line is a polynomial moving average, which is a even better line that fits that data, and you can see that it has rolled over in the last 3 days and is now open to the downside, and that's a measure of the weakness that's beginning to enter the market. If you look to the south of that, the time series on the slope of that 30-day regression line, you can see that about 12 to 15 days ago, the slope of the 30-day line was as high as it has been in the last 6 months, almost two full standard deviations above the 6-month average, and in the last 12 days that has rolled over, crossed its 10-period regression line, and has now fallen below average, which is a sign of just how weak this now is compared to the last 6 months that have been generally bullish in nature. That crossover of the 10-day moving average at an extreme distance from average has always been an alert to a potential turning point in the market, which makes 171 look like an intermediate term high, and we got to be prepared for sharp moves and look out below. It's 7% to the 200-day moving average, and that's where the failure would really begin, and another 8 to 10% below that would not be out of hand in the next 2 weeks. So we've seen that kind of sharp move before, so that's what you got to be prepared for on the downside. You can see in the upper right-hand corner the 6-month time series and see just how smoothly that regression line slope oscillator works and where we stand inside the 6-month period. Lower right-hand corner is price with respect to the 200-day moving average on a percentage basis, and you can see that we've come all the way back to the 6-month moving average, and so this is a market that looks older and weaker rather than young and vital. And so we've got to be concerned here about protecting profits and being alert to the possibility of a change in longer-term market conditions. The rest of the charts are standard technical data for you to complete your trading plans, and so I'm not going to cover those in any detail until we get to this chart. The top chart is the Z-scores of the 3 regression line slopes that we study, the 10, the 30, and the 90. And we've normalized those. On the left-hand side, you can see the plus or minus 1 channel in the yellow. And now what we have in the black line is the 30 that has rolled over from a plus 2 z-score back down to the 6-month averages we've seen previously. At the same time, the 10 has moved from a plus 2 down to a minus 1 and can move even further down to a minus 2. So more weakness is definitely ahead in the short term. Potentially. And now we can see in the red line, finally, the 90 period, the longer term trend, has weakened considerably and is now back inside the channel and rolling over. And that puts the entire move of the last 90 days at risk. And now you can see when you look at price with respect to the river in the southern chart here, that after this last leg up from about 155 to 170, the market has rolled over, pulled back to the bottom of the river, and is just starting to emerge. And that's now the second time in the last month that it has done that. Every other time on the way up, the market quickly found support at the bottom of the river, and it can do that again, and that would not be surprising. And if that happens, we would be looking for a return to 171, and then the market will tell us if it's going to be longer-term leg up, in which case we'd see price moving above 171, closing and going. That would be a sign of a resurgent bull. But in the meantime, we'll take this as a tactical opportunity to trade between 171 on the upside, 154 on the downside, ready for a market that will move sharply in either direction. That's all I want to cover for right now. Again, get the market right, get the volatility right, protect your long-term profits, be ready to respond in either direction on a shorter-term basis, watch your overnight risk, and wait to see price above 171 or below 154 before you start believing in the longer-term trend that emerges. This is Ken Long from Tortoise Capital. Keep your risk measured and your powder dry.